In this section, let's talk about choosing the right mortgage for you and how to figure that out. There are several types of mortgages out there. Each has its own advantages and disadvantages. And so we're going to go in depth about some of the different types of mortgages that are out there and, again, how to better choose which one is best for you. So first, let's talk about the different types of mortgages that exist out there. Number one is a fixed rate mortgage. A fixed rate mortgage is a loan that has a fixed rate. Makes sense, meaning that rate will never change. So typically a 30-year fixed rate mortgage is a very common, most common loan that we do. A second type of loan is an adjustable rate mortgage. An adjustable rate mortgage is a loan that has a rate that can adjust. Typically it's fixed for a short period of time in the beginning, and then it can adjust each, typically year, sometimes even monthly though. Another option for a loan is a government loan. This includes FHA, VA, USDA. Those are considered government loans. Typically there's a reason the government's getting involved in those types of loans, and so there's a little bit more of an incentive or kind of helping mitigate some of the risk for lenders, and so there could be some benefits to doing a government loan as opposed to just a normal conventional loan. The fourth option is a conventional loan. Conventional loan is a loan that includes a fixed rate mortgage, adjustable rate mortgage, those types of loans. That's typically the loan type that most people will do if they're not doing a government loan. These types of loans typically require maybe a higher credit score or a higher down payment for these type of loans. The last type of loan is a jumbo loan. A jumbo loan is a loan for those that are over the conforming loan limits, meaning each year the government says, hey, loans that are above this amount would be considered jumbo. Anything below that is considered a conforming loan, meaning conventional can do it. Government loans have their own limits and different things like that each year. And so anything above those limits is considered a jumbo loan, and you need a different type of loan for that, which is what a jumbo loan is. Jumbo loans do typically have higher interest rates as they are for those that are obviously affording a bigger home. So let's go back to those 5 different types of loans and talk about some of the pros and cons of each of them. So let's talk about a fixed rate mortgage first. Obviously, one of the big benefits of a fixed rate mortgage is the predictability of it. You don't have to worry about things. If interest rates change in the market, hey, and you already locked in a low rate, you're good. You don't have to worry about that rate going up or down. Okay, so that's all the different loan options that are out there. Let's kind of dive in a little bit more detailed here, okay, to kind of see, hey, if I'm a first-time home buyer and I'm looking to go buy a home, what are my options and how do they compare payment-wise? So I put together this little flyer here that kind of outlines, hey, if I'm a first-time home buyer, here's my options. Now, obviously, if you have more money to put down, you have even more options. And frankly, what I'm trying to do here is simplify it a little bit. So if you have different credit scores and different things like that, it's going to vary too and stuff like that. But this is a very simplified thing to just kind of show you basically how all of these loans compare to one another. So let's start with a VA loan. VA loans are for veterans. Obviously, those that have served our country get very good rates and have no mortgage insurance. It is by far the best zero down loan that exists, and rightfully so. You can see that in this scenario for a $400,000 purchase price, assuming these factors as you can kind of see here in the details, it's a very good payment compared to these other ones for veterans. If they have good credit, you can see here's where the payment's at, and if their credit is not so good, obviously the payment goes up a little bit depending on where their credit scores are at. The second loan is a USDA rural housing loan. There's another government loan, and the government is trying to encourage people to live in what's considered rural areas. Each state has rural areas in it, and you can go online and check. There's a map that allows you to look at the different areas so you can see, hey, what areas are considered rural to the U.S. government. If you're looking to then buy in one of those areas, USDA rural housing is a great zero down loan. Not quite as good as VA, but again, a great loan that allows you to get into a home with zero down. USDA loans are a little bit restrictive on debt to income ratios, so it's sometimes harder to qualify for a USDA loan, meaning, on another loan, you may qualify for $400,000. On a USDA loan, you may only qualify for $300,000. And again, that's because they're a little more strict on their debt to income ratios. So again, that's one of the things you'd want to talk to your loan officer about is, hey, do I qualify for rural housing? Because, hey, maybe I'm willing to go to a rural area, and obviously it has a favorable payment and it's a zero down loan. So great loan, but just know that there's some caveats to it when you're looking at doing a USDA loan. This third one here is a zero down loan. Okay, it's a grant-funded loan through one of our partners, UWM, United Wholesale Mortgage. And the reason I put this one in here is just to show you that, hey, there are zero-down loan options out there. In fact, there's more than just this one, depending on which state you're in and different things like that. But this kind of symbolizes, I guess, what I would say a zero-down loan looks like. And so you can see essentially what this loan is it's a hybrid conventional loan, meaning normally a conventional loan requires 3% down for first-time home buyers. This one, instead of you coming up with the 3% down, our lending partner, UWM, is willing to give you that 3% 3% down as a gift. Now, it is a silent second, essentially, okay? Meaning, up to $15,000 is what it is. And so it sits as a second mortgage on the property, which essentially has no interest on it and no payments that are due, but it sits as that silent second. And then when you go to pay off the home or refinance or something like that, you do have to pay off that mortgage at that point. But again, it's for the exact balance that you borrowed when you started that loan. So again, I show you this to show you, hey, there are options for zero down, and they're actually pretty good, compared to some of these other options. The fourth option for a first-time homebuyer would be doing a conventional loan. And if they don't qualify for the 3% down grant program, they could do the 3% down program, or really just for anybody, you can do a 5% down conventional loan. Now, the benefit of doing a 5% conventional loan, if you have good credit and stuff like that, is the payment ends up being pretty good. It's easier to qualify for, meaning a conventional loan is not as strict on debt to income ratios as, say, a USDA loan, but it's not quite as lenient as, say, an FHA loan. Okay, so again, you're able to qualify for a good amount, maybe a little bit more on FHA, maybe a little bit less on USDA. You can also see that conventional loans are very credit driven, meaning if your credit scores are awesome, you're getting a good payment. If your credit scores are not so awesome, hey, the payment does go up because, again, of your credit scores. This again shows you why having a good credit score is really an important factor and something that you want to be working on before or during the process of applying for a home. The last section here is FHA. FHA is a great first-time homebuyer loan because it only requires 3.5% down, which is not terrible. It's not zero, but it's not terrible. The other benefit of FHA is that the interest rates on it are typically a little bit lower than, say, if you did a conventional loan. The reason is FHA is very lenient on credit scores. So if you have a 760 or a 680, typically the interest rate is going to be very similar. Whereas on a conventional loan, if you go from 760 to 680, that interest rate is going to go up. So again, FHA is very lenient when it comes to credit scores and giving you a really good rate for that. The other thing I like about FHA is that it's very lenient on debt to income ratios. Typically, you can borrow more money on an FHA loan than you can on a conventional loan. And the reason is they allow for a higher DTI or debt to income ratio at home, meaning, again, you can get approved for more home under FHA than you could, say, under conventional. Hopefully showing you this little flyer, this little illustration of how each loan compares to one another is helpful for you. Again, this is just for informational purposes. You can see the rates as of the date that I did these. These are not today's rates or anything like that. Again, the purpose of this is just to illustrate how each loan compares. And so based off of today's rates, these may be totally different, but typically they do move in tandem. If FHA rates go up, so do USDA, so does conventional and stuff like that. So again, the difference between these programs should stay relatively about the same. And so hopefully this gives you an idea when trying to figure out what loan may be best for you, which again depends on where your credit scores are, how much of money you have to put down, or how much of a home you're trying to get, different things like that, which is why, again, when we do this pre-approval process, that's super important to go over to figure out what loan makes the most sense for you.